IAS 37 Provisions, Contingent Liabilities and Contingent Assets establishes the principles for recognizing and measuring uncertain liabilities and potential assets within financial statements. The standard is necessary because businesses frequently face obligations involving uncertainty regarding timing, amount, or probability of future outflows. Without clear guidance, entities could manipulate profits by creating excessive provisions or delaying recognition of liabilities. IAS 37 therefore promotes consistency, prudence, and transparency in financial reporting by ensuring that obligations are recognized only when appropriate conditions are satisfied. The standard also prevents overstatement of assets and understatement of liabilities, which could mislead investors and stakeholders. Accurate accounting for provisions and contingencies is essential because these items significantly influence profitability, financial position, risk assessment, and decision-making within international business environments. A provision is defined as a liability of uncertain timing or amount arising from a present obligation resulting from past events. IAS 37 distinguishes between legal obligations, which arise from contracts or legislation, and constructive obligations, which arise from established business practices or public commitments creating valid expectations among stakeholders. A past event, often called an obligating event, must already have occurred for a provision to exist. Additionally, it must be probable that settlement will require an outflow of economic benefits, usually cash or other resources. Examples include warranty obligations, environmental restoration costs, legal disputes, and restructuring activities. Understanding these definitions is important because they determine whether obligations are recognized in financial statements or merely disclosed within accompanying notes. IAS 37 establishes strict criteria governing when provisions may or may not be recognized. A provision is recognized only when three conditions are met. A present obligation exists from a past event, an outflow of economic benefits is probable, and the amount can be estimated reliably. If any condition is not satisfied, no provision is recognized. For example, future operating losses cannot be provided for because they do not arise from present obligations. Similarly, management intentions alone do not create provisions unless valid expectations have been communicated externally. When recognized, provisions are presented as liabilities in the statement of financial position, with related expenses recognized in profit or loss. This disciplined approach prevents earnings manipulation and ensures that financial statements faithfully represent actual obligations and economic circumstances. Measurement of provisions under IAS 37 requires entities to estimate the best expenditure necessary to settle present obligations at the reporting date. Estimation may involve expected value calculations, most likely outcomes, or probability-weighted approaches depending on the nature of the obligation. Risks, uncertainties, and future events that may affect settlement amounts must also be considered. Where material, provisions are discounted to present value using appropriate pre-tax discount rates reflecting current market assessments of time value and risks. Future operating gains are excluded from measurement to maintain prudence. Provisions are reviewed regularly and adjusted when circumstances change. Accurate measurement is important because overestimation can understate profits while underestimation may conceal financial risks and obligations from investors, regulators, and other financial statement users. IAS 37 also addresses contingent liabilities and contingent assets, which differ from recognized provisions because of uncertainty regarding existence or probability. Contingent liabilities are possible obligations arising from past events whose existence depends on uncertain future events, or present obligations not recognized because outflows are not probable or measurable reliably. Examples include unresolved legal disputes or guarantees. Contingent liabilities are generally disclosed in notes unless outflows are remote. Contingent assets represent possible assets arising from past events whose realization depends on uncertain future events, such as pending litigation claims. Contingent assets are not recognized until realization becomes virtually certain because premature recognition could overstate financial performance. These disclosure requirements enhance transparency while maintaining prudent reporting principles. Special applications of IAS 37 include onerous contracts, environmental obligations, and restructuring provisions. An onerous contract exists when unavoidable costs of fulfilling contractual obligations exceed expected economic benefits. Entities must recognize provisions for unavoidable losses immediately. Environmental provisions commonly arise from obligations to restore contaminated land, dismantle facilities, or comply with environmental regulations. Such provisions are recognized when obligations exist and future costs can be estimated reliably. Restructuring provisions may arise during major organizational changes involving closures, layoffs, or operational relocations. However, provisions are recognized only when detailed formal plans exist and valid expectations have been created among affected parties. These specialized applications demonstrate how IAS 37 addresses diverse operational risks and obligations encountered in modern business environments. Restructuring provisions require particularly careful consideration because management intentions alone do not justify recognition. IAS 37 requires entities to establish detailed restructuring plans specifying affected operations, estimated expenditures, implementation timelines, and impacted employees or stakeholders. Additionally, affected parties must have a valid expectation that restructuring will occur, often through formal announcements or implementation actions. Only direct expenditures necessarily resulting from restructuring may be included within provisions. Costs associated with future operations, staff retraining, marketing, or new investments are excluded because they do not relate to present obligations. This guidance prevents premature recognition of future operating expenses as liabilities. Proper accounting for restructuring activities ensures transparency, protects comparability, and maintains reliability within international financial reporting practices governed by IFRS accounting standards. Overall, IAS 37 provides a comprehensive framework for recognizing, measuring, and disclosing uncertain obligations and potential assets within financial statements. By establishing strict recognition criteria and prudent measurement principles, the standard improves consistency, reliability, and transparency in international financial reporting. Accurate accounting for provisions, contingent liabilities, and contingent assets ensures that financial statements reflect genuine economic obligations while preventing earnings manipulation and asset overstatement. Specialized guidance on onerous contracts, environmental provisions, and restructuring activities further strengthens the practical application of IFRS accounting standards in complex business environments. For DIP-IFR candidates, understanding IAS 37 is essential because provisions and contingencies significantly affect profitability, risk analysis, financial position assessment, and stakeholder confidence in reported financial information.